FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and guess what? Today is 1/9/20, and this year is just going right by so quickly. If you remember last year, we started out the year, gold was down in the mid 1200s. We had a webcast. If you missed it, you should go back and replay it. Our good friend Craig Hemke, aka Turd Ferguson, was on that webcast. It was for Orin Resources, has like some amazing projects. They're a show sponsor, I should disclose up front, but really high quality. It's the kind of company we're so proud to have as a client. When Craig, you were on that webcast, you said this 2019 is going to be like 2009, and you even did a chart. And sure enough, like midway through the year, everything hit the fan, and precious metals started going up. And then they consolidated, then they got slammed down, and then just like clockwork, last week of December, they start going up again. And here we are now, gold well over 1,500, in the mid 1,500s. It broke through that technical resistance, 1,550, at least the way I calculate the technical resistance. And, you know, you really got to, I got to hand it to you, because you nailed that market last year better than anybody else.
Hey, I appreciate that, Kerry. I'll take all the attaboys I can get, because all the stuff I get wrong from time to time, and certainly everybody gets those, man, the trolls pounce on it. So, what's interesting is that the signposts were all there. You just had to see them last year at this time. And you remember the stock market had just collapsed in December of 2018.
Right.
And that was all due. I mean, it was just kind of this accumulation of all the money that the cash that the Fed had extracted back out, you know, with trimming their balance sheet, and the 10-year note got up to 3.25%. And it was like the stock market kind of caught down to that decreasing money supply. And so, I mean, it wasn't real complicated to figure out that the Fed was going to reverse course and they were going to start increasing the money supply again, and that would have a positive impact on the metals in a way that was going to look a lot like 2010, when that was all went kind of through the same process. And so we thought last year would be the best gains for the metals since 2010, and they were. And the important thing for people to realize as they listen, you know, to this podcast today, or maybe it's over the weekend, like you said, we are over 1,500, 1,550 is a key level. We'll see if we can finish there once we get into the Friday close. But, you know, don't go thinking that this is somehow, you know, well, that's just because of all the war fears. No, we were at 1,530 already before they took out this Soleimani guy. And so gold's moving up for reasons that have nothing to do with, you know, safe haven, you know, that kind of stuff. You know, if those gains get all reversed back out, okay, fine. But the rationale for owning gold in all its forms that has driven price to where it is coming out of 2019, all that stuff remains in place. And so it should be a really good year in 2020 as well.
I totally agree with you. And I think the fact, even though it didn't stay, you know, we had all the war fears and the Iraqi Irani rather, everybody's messing that up. Like, I heard a senator on the TV call Iran Iraq, and I heard Biden. Well, he doesn't even know where the Middle East is anymore. But
well, we're so used to Iraq after 3 decades or whatever.
Yeah. So, but it briefly went over 1,600. 1606, I think, was where it hit, and then war fears immediately receded, and the price immediately receded, and we're down on Wednesday, you know, $15, $16 an ounce. You kind of expect that, and yet the whole whatever is driving gold higher, my view of it is that all the geopolitical tensions are just an excuse for gold to go higher. It was going to go higher no matter what. It was just waiting for that little spark, that little catalyst to shoot it higher. And it did.
But Kerry, last year, in December of last year, gold started to rally. And Everybody was saying, well, this is just safe haven because the stock market's going down. That's the only reason gold's going up. And so once the stock market recovers, gold's going to go back down. And it didn't. You know, and the stock market magically rallied after the day after. You know, remember Mnuchin called the plunge protection team together on a phone call on Christmas Eve. Yeah. And then magically the day after Christmas, the next time the market opens, the Dow goes up 1,000 and never looked back. And gold kept going. And because it wasn't a safe haven deal, and it's not a safe haven deal now. The conditions that are driving the demand for gold in all its forms, whether it's physical gold at the central bank level, you know, and investor level, or whether it's futures contracts with open interest on the COMEX at all-time highs, or unallocated accounts, ETFs, you name it. The conditions that are driving that demand are going to continue in 2020. And I mean, we can talk about those conditions, and I'll make sure I send you a link, Kerry, to the kind of public forecast I put out. I try to do one every January just as like a roadmap. Last year's roadmap, as you said, worked out pretty well. The one this year is free on my site. I'll send you a link. Anybody can read it. It's called 2020 Foresight. And we lay out, or I lay out, you know, just as a reminder, really. I mean, it's not like rocket science, like I'm, inventing fire or something, or splitting the atom.
Well, no.
This is all there for anybody to see. You just have to be willing to look.
Yeah, well, hey, you're a little too self-deprecating here, because I want you to come up with that chart if you can find it and show that chart that you had created, and it followed. You showed that 2019 was going to follow 2009 almost exact. You were one of the first people to say that they would be cutting rates. In September, we had a podcast. You said September, and they started doing it, I think, in June. You were a little late there. It was a surprise to everyone. And, you know, so really your call from last year into this year is pretty astounding. And, you know, what's cool is, like, we know that every end of December, Q1, generally 80% of the time, gold goes up. I mean, that's the way it works, seasonality. And everybody's wondering, oh, is it going to happen this year? Is it going to happen? When is it going to happen? And sure enough, like clockwork, third week of December, it started. And like you said, the things that are driving gold higher, really, the geopolitical thing really isn't what it's about, at least on the surface anyway.
Right.
We got a lot of other factors.
The primary factor, and people need to understand, I mean, just the math of this, right? Late December, middle December, the Congressional Budget Office comes out with a report. And again, now they base their stuff on like no recessions ever, nonstop economic growth of 2.5% or something like that. And even on those optimistic forecasts, which give them government revenue tax receipt forecast, tax to play off of the deficit spending, even with all these rosy economic assumptions, the CBO projected $1.2 trillion deficits all the way through this decade. That's $12 trillion. Now, again, without getting into the politics of all that, the simple question is, where's that going to come from? Right? I mean, where's that cash going to come from? We're already seeing the Chinese, the Russians back away. The Japanese are trying to absorb some of this treasury supply. And most people think the root of this, what's called the repo crisis, is all of this treasury issuance, because most of these big banks in the U.S., JP Morgan, Goldman Sachs, Morgan Stanley, whatever, they act as what are called primary dealers for the Fed, which means, or for the Treasury, which means when the Treasury issues the bonds, they don't sell them directly. They are marketed and sold, and the market is supported by these primary dealer banks. Okay, kind of like in the stock market, we used to have specialists on the floor of the exchange. Everybody watch CNBC now. It's like the floor of the exchange, the ghost town, right?
Yeah.
I mean, there's nobody there. Well, it used to be.
It's a stage set.
This hub of activity, remember?
Yeah.
And guys streaming everywhere in this, and you'd go to the desk where the specialist had a book. He ran the book on 2 or 3 or 4 stocks. And that guy was responsible for making a market. So if there was ever a time when everybody was trying to sell, his job was he had to buy, so that there would always, try to maintain an orderly market. Now, that was the risk the guy had to take. But most of the time, God, he makes a killing. I mean, it's a really rich.
Yeah.
I mean, they made a lot of money doing that stuff.
Oh, it was.
Well, anyway, these primary dealers do the same thing for the treasury auctions. Most of the time, they just make a boatload of money, with a little bit of margin every time they make the market and resell these treasuries as they're issued. Well, sometimes they have to step in and they've got to absorb them. And a lot of folks think that's what sparked this repo crisis beginning back in September, because the government had been on a debt ceiling, spending freeze, and Mnuchin was moving money around. When that came off in August, the government issued about $800 billion of debt in September and October. And that sudden flood, they couldn't find enough buyers. It soaked up the excess reserves of some of these primary dealer banks. And we've had this repo liquidity crisis ever since that now continues. And it was when that happened that suddenly in October, Chairman Powell comes out and announces what is essentially QE, right? $60 billion a month in T-bills that they're buying through June. Now, people say, well, he tries to say it's not QE. Well, okay, fine. What it is it's direct monetization of the debt by printing new cash and buying this debt, again, to the tune of $60 billion a month, stated through June. Well, okay, let's do the math. This fiscal year began in September, or the calendar year begins this month. However you want to look at it, $60 billion a month by June is 360. For a full year, that'd be 720. And the deficit is 1.2 trillion. Okay, so they're monetizing almost half the debt already.
That's an unbelievable number. And it's QE4 by any other name. And how much, the repo market is 2.2 trillion per day. And that's grown enormously. It's been around since World War I. It was a means of providing liquidity to banks where they would post their collateral. And now it's grown into much more than that. Our good friend Daryl Schoon calls it pawn shop for banks.
Yeah,
right.
What it is.
Now you got hedge funds in there. You got money market funds. So any one number of those players could have busted out. We don't even know it. They're not telling us. I think there's a lot more to the repo meltdown than anybody is really saying.
FSN Radio. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
And I agree with you. But either way, this isn't going away. I mean, the deficit has to be funded. The only way it can be done is through this continued direct monetization of the debt by the Fed. They admitted as much. A lot of people miss this. Last Friday, the 3rd, usually the minutes of the FOMC meeting are released 3 weeks later. And the FOMC meetings end on Wednesdays. And so those minutes usually come out on Wednesday, 3 weeks later. Well, with all the holidays, they weren't released until last Friday, the 3rd. Well, nobody's paying attention, right? I mean, most people are still on holiday. Well, anyway, in those minutes, the Fed actually admitted, and I include this in the little snippet of it from the PDF in my 2020 Foresight post. They admitted, if this risk to liquidity continues, they're going to have to expand to notes, which is not just treasury bills, which is less than 1-year maturities. We're talking 2-year notes, 5-year notes, 7-year notes, 10-year notes. Again, they're telling you this is coming. Just as a year ago at this time, anyone could see that the economy couldn't withstand high interest rates, neither the federal debt, private debt, credit cards, home loans, auto loans. I mean, it just couldn't happen. And so the Fed was going to have to reverse course, stop their turning of the balance sheet, start adding to it again. They've already built it all the way back up to $4 trillion. And they're going to have to cut rates. Anybody can see this happening. And so when you connect those dots, you go, well, I guess gold and silver are probably going to have a good year.
Mm-hmm.
And so now it's just the same thing now. You just got to get past the noise and the crap and the BS that's spewed by people that don't know what they're talking about, that are trying to convince you to stay in mutual funds or whatever so they can collect their fees. Look, gold and silver have a place in every portfolio. They are They are money, and they are a diversification that everybody should have. And I'm just telling you, I mean, prices are going to be higher a year from now, so you might as well take action and buy them while they're still cheap.
Yeah, and the stocks, even though they didn't do well, they were down to a near decade low on the venture, the Toronto, the TSX venture. And then in December, man, it just shot up. I think it went up 8% in December, something like that, or it was a major increase. And
that HUI index, the HUI Gold Bugs Index, as they call it, rose actually 20% through earlier this week from October the 15th. So over about a 10-week period, it went from 200 to 240. So that was a pretty good run right there.
Yeah, really nice run. And we're going to see more of it,
Yes.
Definitely going to see more. So
I think that's actually probably where most of the gains will be this year, because we know the banks are going to fight us every step of the way in the paper markets. And they've already increased the total amount of contracts on the COMEX by 73% last year.
Oh, my God.
73%. Price was up 18, even though they increased the supply of contracts, which the trading of which determines the price, by 73%. Yeah. What if they hadn't been able to do that? How much would price have gone up? But I digress. They're going to fight us, So I don't know. What's a good target for this year? 1650, maybe 1750. At that point, eventually, the shares are going to move to highs that they haven't seen since 2016 and beyond. And once that happens, the large institutions, the mutual funds, the hedge funds, the pension funds, and the like, will start crowding into the sector. And when they do, there's only so many places for that money to go, and things are going to move pretty quick. So I think for anybody that wants to, try to make some fiat, some trading profits, it's not necessarily from trading the metals this year as much as I think you can probably make some pretty healthy gains trading the miners.
Oh, yeah, I'm convinced. And I see a lot of good companies. The best thing that happened from the dark period there for the past 8 years is it blew out a lot of bad actors and a lot of marginal companies. And they're gone now. And I won't say that only good ones are left, but most of the ones that are left are certainly better and higher grade than what was out there before. So all of that combined, you can expect to see, loads more taking place here. Really.
I agree. And again, just the simple math then, because like you said, if you made it through 13 to 15 and you're still a operating company, you're probably pretty lean and mean and ready to roll. And we already saw, the third quarter earnings for all the major producing companies came out in October and November, late November or whatever. And year over year, right? Because in October, the third quarter of 2018, prices are down 1,200 some odd bucks. And in the third quarter of this year, they're 1,500 bucks. And so you're seeing some of these big companies, Newmont, Agnico Eagle, things like that. Their earnings are 3 to 4 to 5 times greater year over year. Well, now, that drove a lot of interest, in the fourth quarter. Well, now we're entering, we're going to start getting fourth quarter earnings as late as, by the end of this month and in February. And it's the same thing. You go back to the fourth quarter last year, gold was down at $1,250. There we are at $1,550. And you're going to get another round of earnings reports showing 3 and 4 and 5 times earnings growth. What then, even into the second quarter or the first quarter of this year, first quarter of last year, we were down in the 13s and we're going to be in the, high 15s or wherever. All of these continually repeating massive earnings growth. And God forbid, we're right about gold and it does go to 16 or 1700. Eventually that just won't be ignored. I mean, it won't be consigned to the realm of the day traders and all that kind of stuff. And this big flow of institutions, the trillions and trillions of dollars in the markets worldwide, we get a little itty bitty sliver of that into our sector.
Yeah.
And what's the old thing about a rising tide lifts all the boats, right?
Oh, yeah. Yep. No doubt. I'm totally with you on that. And by the way, in the show notes to this interview, there is a link to Craig's 2020 Foresight report. Just click it. It'll bring you right to his site and take a look at it. I think it's really important. And I think we barely scratched the surface of what's going to happen in 2020. I think this will be the most amazing year on record that we've ever seen, Craig. I really do. I've not felt this way since 2011 and 2010. I feel like we're entering the cycle yet again. You look at the trading patterns, and I'm not that smart or that great a trader, but I can recognize patterns, and the pattern in the metals and in the stock market, it's just totally recognizable. And to me, it's flashing a major signal right now.
Well, and I would just remind people, I mean, we kind of talked about this while we've been discussing these things over the last, few minutes. Last year at this time and in December of 2018, it was everybody because nobody pays attention to gold, right? Nobody watches. And then all of a sudden it spikes and people then, oh, look at that. And then they try to ascribe rationale to it. And last year it was, well, the stock market's going down, so gold's going up. No. Gold was going up because it was anticipating, it was looking forward 6 months, the change in Fed policy and the cutting of interest rates and the slowing of the economy and all that stuff. That's why gold was going up. So now you're going to be told over the next few days by the people that weren't paying attention in December, because nobody cares, that the only reason gold has been going up was because of war fears. Well, okay. I mean, earlier this week, yeah, but not in November and December, it wasn't. And again, in November and December, it was anticipating again where things are headed this year. And so don't be fooled if you're listening to us into thinking that, well, gold's only gone up because of and now that's going back to the back burner. Gold's going up for the stuff we talked about dollar debasement, debt monetization, the ongoing repo crisis, liquidity crisis, all of the steps the Fed's going to have to take in 2020 to combat that, keep the plate spinning. So if you understand that and you can look ahead and you can begin to think about, this funnel that all this massive institutional money is going to go through trying to get into the sector, I think if you're smart and you look around, you're paying attention, you can position yourself for some fun in 2020.
And some profits. And, you can look at our sponsor companies. We've got 5 or 6 of them now. Amazing companies. They're all poised for growth. We, hey, they pay us to say nice things about them, but we don't just take money from anybody just to say nice things about them. We do our due diligence and we make sure that they are solid prospects and have solid prospects for the future, and all of them do. And if there's a couple catalysts that hit them and they take off, I think it could really be an amazing year for all of those companies. So anyways, hey, so people, you need to sign up at Craig's site. Just tell them what to do there, Craig.
Well, in that link, that'll take you to that report that I wrote last weekend, 2020 Foresight. That'll take you to the site. The link is free. Anybody can read it. And then at the bottom, it just talks about the service and the site. And there's a link there with a video. If you click the link, it takes you to our subscription page and you can learn how to subscribe. I mean, it's only $12 a month. So, I mean, it's not like I'm getting rich doing this. But I think the site is extremely valuable and it's a money well spent. So I just, this is a time, I mean, this is fun again. This is like 2010, 2011. We're in a bull market in the precious metals. And so now's the time to be paying attention. And I think there's no better way to do that than to be a member at TF Metals Report. So thanks for having me on, Kerry.
Hey, it's always a pleasure. Hey, the link is in the show notes. Just click it, take you right to Craig's site. Check out our site, financialsurvivalnetwork.com. The Twitter feed is at Kerry Lutz, Facebook, Financial Survival Network. And Craig, we will catch up with you again, no doubt, in the coming months ahead. I think it's a good time to be buckling your seatbelt.
Yeah, I hear you, my friend. I look forward to talking again soon.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.